We all know the property markets move up and down, but do you understand what drives the property cycles? That's what Dr. Andrew Wilson discusses in this week's Property Insider Chat. He also shows us the total return for properties state by state over the last 12 months. And some of those results are very surprising. We also talk about what property has done compared to the share market. What's a better investment? If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. I've often said you can't be a good property investor till you've invested through a couple of property cycles and understand how they work. Look, while clearly each cycle is different, there are some similarities in having now invested for over 5 decades and through 8 property cycles, I can see patterns in the chaos that others see. And that's why in this week's Property Insider Chat, I'm going to ask Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, to give us a primer on housing cycles. I'd also like his thoughts on the age-old conundrum of whether you should invest in properties or shares, with the stock market being near record highs. And at the moment, there's a number of headwinds for our housing markets. There are commentators out there suggesting shares are a better investment. But is this true? Let's find out. Hi, Andrew.
Yeah, good day, Michael. And I think everybody's got their favourite vehicle for investment, and just be wary of those that are promoting shares, because sometimes they actually have a vested interest in that promotion. That's another story, isn't it?
Now, Andrew, anyone who's been in the property in the last couple of years has noticed how cyclical the market is. We've had a downturn and then it went up again and then it went down in 22 and it's up again. And I think it's important to understand basics of property cycles. I know you've got your own model, the Wilson curve, that I find fascinating, but maybe you could give us a bit of a primer about house price cycles.
Yes, Michael. Well, we do move in a cycle. It's not some people seem to think it's some underlying mechanism that sort of self-perpetuates, that it's a system rather than the outcome of unpredictable events. But when we do look at the cycle, we have business cycles because confidence rises and falls and people take more risk on, and then that leads them to, have less risk down the track. So that's just the normal business cycle pattern. And of course, we see the same thing in housing markets, and that's exacerbated by outside of events. Could we call them black swan events, such as changes in interest rates and changes in the international environment and things like COVID, of course, and what we have experienced, the GFC was one factor. So we get these cycles. It's interesting, we can actually look at the performance of housing markets in a comparative basis when we measure the actual cycles. The first point we have to set up is understanding what a cycle is. Of course, it has peaks and troughs. It has that particular shape. The interesting thing about the Australian housing market is it has an upward trend. We can create a model that's not just a basic bell-shaped wave. It has a particular trend. So that's what I've done in my model, which has been around now for some time. And it's been very good in understanding the underlying dynamics on a comparative basis of housing markets. But what our starting point in terms of the model is the peak and trough points. If we look at the previous peak points in our major capital cities, we can see that Perth's previous peak point was in June 2022, because we can pick the cycles out and we can clearly see that when we look at the cyclical diagrams on a quarterly basis. So the previous peak was June 2022, and of course that was the sort of post-COVID boom peak. And Perth house prices are up by 23% since then, Michael. Similarly, Adelaide, May 22, up by 11.6%. Melbourne's previous peak, also May 22. Melbourne's up by 8.2% since that peak, down 1%. Sydney since its previous peak, and Brisbane is down 4.8% since then. So if we create a model based on the theoretical shape of that trough, we can see that it's characterised, and this is the model that I use, it's characterised by the trough and the peak points. As prices start moving below a peak point, we move into a correction phase, because we want to know what the phases are. So we name some phases to understand where our markets are situated on the cycle. As prices fall, once they move below the previous trough point in that correction phase. They move into a contraction phase. But Australian housing markets, and that's why this shape has an upward bias to it, typically the trough points are higher from cycle to cycle. So we never move into that contraction phase, which if you look at the shape gives us that sort of bubble myth scenario. We don't hear much about the bubble anymore, and that's why this shape reflects exactly what happens in the Australian housing markets. We don't have these bubbles. If we did, we'd see that shape there as we moved into the contraction phase, because typically prices start moving where the trough point is higher than the previous trough point. We then move into a recovery phase, and once we move above the previous peak point, we move into an expansion phase. So, and then on we go in terms of the cycle. Now, if we put those all together at the moment in terms of where the previous peak points are, which I showed you before, and the current rate of growth, we can situate our housing markets on the cycle, Michael. And it shows us that Melbourne is the underperformer there in terms of the housing market cycle comparative to other capital cities. It's still well below an expansion phase. It's in the recovery phase, but unfortunately, it's not heading upwards in the recovery phase. It's actually heading downwards. It's moved upwards, but it's certainly below the others in terms of its position relative to the expansion phase. Sydney just below the expansion phase, but rising upwards. But Brisbane, Adelaide and Perth, which have had strong results over the past year and certainly continuing to have strong results, as we can see there by that price growth, are well and truly in the expansion phase and moving upwards. So in a sense, yes, it shows the strong markets in the expansion phase, Michael. Brisbane, Adelaide and Perth ahead of steam up. Those markets are tracking at record levels, but Sydney and Melbourne actually had good value for buyers. And I think that's why we're particularly seeing the Sydney market reasonably robust at the moment, is because prices, as we saw, are still below the previous peak, Michael, which was back in March 2022. So I think that's part of what's driving a good, strong start to the Sydney market this year, is the fact that it's in terms of the cycle, it hasn't recovered to be above its previous peak point, which was the best part of 2 years ago. So that's an interesting analysis, and it gives us some insight into the current performance and the potential performance of our capital city housing markets in a relative sense, comparing one to the other.
Well, if you look at the potential performance going way back to 2007, as you showed, or even longer as far as the ABS statistics go, the long-term trend is up, but in between there's ups and downs, and really property investors and homeowners should have a long-term focus. Look over 10 years. They should wonder where the market's going to be in a decade's time, not what interest rates are going to do next weekend, should they?
Yeah, that's right. And I think that there's significantly more ups and downs, and that gives us that upward bias, which you can see on any measure. And as I said, the bubble nonsense has disappeared, just cheap headlines.
Because we know that 50% of homeowners don't even have a mortgage. So the $11 trillion housing market overall has about $2.3 trillion worth of loans against it. It's too big to fail, and it really is underpinned by homeowners who aren't going to sell up if interest rates go up or if things get difficult. The investors tend to come in and out of the market and drive the little booms and downturns in some ways. We're a society who want to own our own homes, very different to other countries, Andrew.
Yeah, and look, the important thing about interest rates, and there's a lot of nonsense spoken about interest rates, but there's a lot of nonsense as we discuss regularly here. But the point is that higher interest rates mean a strong economy and lower interest rates mean a weaker economy. So, I mean, that's the reality. But just getting back to Melbourne, I think that cyclical model also shows us that Melbourne represents pretty good value. And that's why we've been saying that we believe that there's certainly the data tells us that there's potential for an upswing in that Melbourne market, particularly as the migration surge continues. We're seeing increased rental returns now in Melbourne, and I would expect to start to see the Melbourne market pick up again. It really has suffered from what was a severe COVID period in Melbourne, which we all know about. And I think there's just still some recovery from that happening. But I think that the cyclical model shows us that there's some good potential in that Melbourne market going forward.
Well, let's have a look at what's happening with investment in properties at the moment. There's two ways you get your returns, of course, Andrew. There's capital growth, but also yield. But with interest rates rising and cash flow being tight for a lot of investors, more concentrating on yield. That's a short-term thing in my mind. But how are properties returning income at the moment with regard to yield?
Yes, Michael. Well, of course, we do focus monthly on the latest rent price data. But when we put that all together, as you said, that gives us what investors gaining as a return. And gross yields are one mechanism we use that. And gross yield measurements are actually a good indicator of potential growth in housing markets, interestingly enough. And if we look at the first lot of yield for houses, typically house yields are lower than unit yields. And when we look at the latest data, now what this does is the February quarter data, Michael, which is measuring the value of the median house price over that February quarter. And then what we do is we use the annual return with the latest rents to give us a yield. So this is a gross yield. At the moment, for the house market, Perth is on top and it's returning around about 4% per annum with the latest data, followed closely by Brisbane. Well, Brisbane at 3.5%, and Adelaide closely behind that, also at 3.5%. So yeah, gross yields, Perth on top at 4%, Brisbane, Adelaide around 3.5%, and Melbourne and Sydney lower, Sydney the lowest at just 2.6%. So sometimes a high yield can indicate that a number of factors, Michael. Obviously, it can mean a high rent with a low asset base, but it can mean a lower rent with a high asset base with a lower yield. So sometimes a high yield relative to other markets, similar markets, so a high capital city yield, can indicate that the capital value is too high and that it should come down because it's producing a higher return given the value of the particular asset. If you can sort of follow me what I'm saying. So it can indicate that there's some downward pressure on the asset value because of the high return, because in a sense, asset values tend to move towards the median or the mean, the average levels. So, but what's happening now, Michael, is interesting, is that we're getting the best of both worlds for investors, which is higher rents. Of course, we know that rents are skyrocketing, and also higher prices. So this is, in a sense, unusual because those higher yielding capitals typically end up moving downwards. We've seen that with Canberra over the last 12 months. But in these circumstances, rents are still very strong in terms of rental growth, and we're still maintaining these quite high yields in a relative sense. So as I said, Perth has the highest house yields, 4%. And when we look at unit yields, similarly, Perth is significantly higher than the rest. Perth has a unit investment yield of over 7%. And similarly, Brisbane has over 6%, well, actually nearly 7% as well, which is a very big result for Brisbane. I think what we're seeing, Perth and Adelaide, we tend to take with a grain of salt its unit market because it's a small unit market. So we can get some volatile results as a result of the fact that there's not a lot of units in those markets, Adelaide and Perth. I'm not discounting it. There are still units. But when we look at the Brisbane market, there's no such differentiation because the Brisbane market is a strong unit market, Michael, particularly inner city Brisbane now. Of course, we know from that building boom of a decade ago, but the Brisbane unit market is still returning nearly 7%, which is quite spectacular. And followed by Melbourne, 5.3%. And the Melbourne higher return there is because the level of rents in Melbourne for units are higher than the relative position of unit prices in Melbourne compared to the other capitals, if you understand what I mean. Because the unit market in Melbourne has been a little flat, but rents are starting to rise now in Melbourne. So even if the values stay flat, the yields will be maintained because rents are rising quite quickly at the moment. So again, a reasonable prospect there for investors in units in the capital cities, and Sydney, the underperformer there, but still returning 5%, Michael, and these are gross yields. Now, if we move forward, of course, yields are not just the returns that investors look for with their property investments. Of course, they're very interested in capital growth. So if we look at the growth in investment outcomes for houses, when we put together the yields, remember we looked at the yields before? Now we're going to add the capital growth from last year to the yields. And look at these results. We've got Perth total gross annual investment return. So that's inclusive of yields and capital growth over the 12 months to the February quarter is 26.33%. Brisbane up 18%. And these are houses, remember? Adelaide similarly up 17%, Sydney up 11%, and Melbourne, the underperformer, up by 5.45%. So those smaller major capital city markets, if that makes sense, are certainly providing big overall returns there for investors and houses. And as I said, I think the prospect is that these aren't top heavy because we're still seeing prices rise, which would typically mean that yields would fall. But the point is that prices are still rising strongly in all capital cities, with the exception perhaps of Melbourne. which would mean for those capitals that are producing high total returns now, perhaps lower yields. But we're also seeing rents rise quickly as well, Michael. So that's houses, Michael. But when we look at the total returns on units, it's just as spectacular. 27% return in Perth for units. Again, mentioning that this is a smaller market, so we need to take these results with a grain of salt with Perth and Adelaide. But Brisbane, 23% total returns for Brisbane units, which again reflects how strong that Southeast Queensland market has been through the post-COVID period, and some very strong results there. Total results, Brisbane 23%, as I mentioned, Sydney up 10%, Melbourne similarly up 10% as well. So those smaller markets are producing some very strong returns, gross returns for investors, Michael. And as I said, the thing to really be aware of here, even though the capital growth is strong, it's not outpacing the yield capacity because rental growth is strong as well.
Well, as you said, that's quite unusual. Usually when there's periods of rental growth, capital growth isn't as high and vice versa, other than during speculative booms, but I can't see any evidence of that at the moment. So I guess now let's have a look at how this compares to the share market, where there's similarly capital growth and the value of your shares. All ordinaries is a good way of looking at that. And of course, investors get dividends from shares too.
Yeah, and of course, what I've done here, Michael, is I've just compared the growth in the share market. And of course, it's an aggregated growth measure, which is the All Ords, which is an index of share results. But of course, those that are particularly attracted to the share market and will be wanting to defend it will say, well, you know, it depends where you start and it depends where you finish. But I've given some thought to that, Michael. So my starting point here is the end of 2007. And we had two things happening there. We had an absolutely booming share market on the back of a remarkable mining boom. The share market leapt into record stratospheric levels towards the end of 2007. And we also had a house price boom, Michael. Even though we had interest rates rising through that period, we had a house price boom as well. So it's a good starting point because there was some consistency in the trend performance and the cyclical performance of both the share market and house prices at that point. So that's why I've started at the end of 2007 from the previous peak in the All Ords and the peak prices in the capital cities. Now, when we look at the performance up until the latest data, which is taken it up to February, we can see that the All Ords has increased by 14.2%, Michael, over that period of time, which isn't really great when you consider the length of time. I mean, we're talking the best part of 20 years here and just a 14.2% increase. And in that same period, Sydney house prices up 167.9%, Melbourne house prices up 130%, Brisbane up nearly 100%, Adelaide nearly 100%, and Perth, the underperformer there, up by 47.4%. But as I mentioned, depends where you take the starting point. I think this is a pretty fair point to take a starting point, but Perth prices had actually had a higher peak during that period. But nonetheless, it does show a big disparity between the growth of the Australian share market and the growth in house prices over that near 20-year period, Michael.
People are going to think, well, I'm not interested in shares, but they've probably forgotten that we've all got superannuation, compulsory superannuation, and that's where much of the superannuation funds are invested, Andrew.
Absolutely. I was going to mention that it's not good news for those with superannuation funds, because if you do look at what happens in the share market, you can see almost on a matching basis that your super fund tracks what's happening in the share market. And that's because that's basically what most super funds do. And look, there is a lot of question marks and perhaps dissatisfaction about the returns on super funds, particularly not keeping up with other asset classes. There's also been a lot of satisfaction about the change in the tax advantages for super, which have constantly changed as governments have come and gone, almost an irresistible tackling what happens in super funds for governments to change the tax mix to make it, you know, in a sense, even less attractive. But certainly the gross returns, when we can use that, and I know there are other factors you can get share market, just as there are with the housing market, there's a number of taxation issues there, similarly in the All Ords. But when we just look at overall gross returns, there's a significant disparity there, Michael. So I'm being a little naughty there. But just on the basis of that, and so we're not just sort of bagging the share market, the US share market has doubled in that time. It's up by 200% over that period. So the US share market, so it's not just share markets, it's actually the Australian share market, which has clearly underperformed since the end of that 2007 mining boom. As I said, the US share market is up by around about 200% and still rising strongly as we speak.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Now, this weekend, there was a bit of a busier auction weekend, and it's the lead up to Easter time when there's going to be a break as well.
Yeah.
How did our auction markets cope with the bigger volumes this weekend, Andrew?
Look, Michael, we've had a remarkable start to the year with auctions. All those that were chanting the supply-demand nonsense, the sort of the quasi-economists and pseudo-academics who tell us that the reason we had a strengthening market last year because we had such small listings, and yet this year we've had record listings, auction listings across the board for this time of the year, and yet we've got higher clearance rates. And of course, we always say we know, which a lot of commentators seem to ignore, the fact that most buyers are sellers and sellers are buyers. So it's all about being in that one environment. But yes, we've had a remarkable start to this year, Michael. We've had record numbers of auctions over this period of time. And it's not just a couple of markets that are experience a surge in sellers. It's most of the capital city markets. And it's still generating a significant solid to strong clearance rates, Michael, which has meant record sales. So the actual number of sales this year, auction sales, is at record levels. So once again, it sets back the nonsense that's peddled around the traps in terms of the auction market. So this weekend, as you said, Michael, we've had, I guess, a resumption. Last weekend, we had a holiday break in Adelaide, Canberra, and Melbourne. Labor Day in Melbourne, long weekend. We had Canberra Day in Canberra, and we had the Adelaide Cup Day in Adelaide. But this week, we bounced back. I guess the big picture is what I'm saying in terms of the numbers of auctions coming through is that, yes, eventually it does put some downward pressure on clearance rates, because a lot of the unsatisfied demand is satisfied and we move on. Clearance rates were just down. We saw Sydney, 836 auctions. Weekend after weekend in Sydney, we're getting plus 800 auctions, which is quite remarkable. Auction clearance rate, still a good result there for most sellers, 71.3%, down from 74.5%. Melbourne's been holding in the mid-60s, but it was down slightly from the previous weekend, 65.2 compared to 67.5. But 1,290 auctions, Michael, in Melbourne following the Labor Day long weekend. That's a lot of auctions.
That's a huge number. It also shows the depth of the market because there were multiple bidders at each of those auctions, weren't there?
Yeah, and as I said, we just look back to last year, the same weekend, and there are only 655 auctions in Sydney. And its clearance rate wasn't that much different from where it is now. So those that sort of peddled last year, it's all about low listings numbers, where the self-appointed experts were all coalescing around that. They compare this. Look at Melbourne last year, Michael, 912 compared to 1,290. And the clearance rate is about the same. So I don't know where the logic goes to there. Brisbane, 120 auctions versus 80 auctions last year. This is remarkable. Adelaide, 115 auctions versus 79 auctions last year. Canberra, around about the same. So again, clearance rates holding down slightly in Melbourne, down in Brisbane. Brisbane tends to be volatile from weekend to weekend, but still, for the Brisbane market, anything over 50 is a positive. Adelaide down from its 80% the previous week, 74.4. But again, big auction numbers in Adelaide. And Canberra, which has shown some early signs of revival, that Canberra market, it was also down slightly, and obviously a big day following the Canberra Day weekend, the previous weekend. So that's what we're seeing, Michael, is just the weight of choices now that the buyers have is starting to put some slight downward pressure on clearance rates. Now, next weekend, Michael, is the weekend before Easter. We're going to have another very big day. I think we could get close to 1,500 auctions in Melbourne next weekend, Michael, and 1,000 auctions plus in Sydney. So that's really going to test the market because there's plenty of choices out there. So look, it's good news there for sellers and buyers in a sense. I think these clearance rates are still reasonably in favour of sellers, but not as strong as they were. But given the context of all these choices that buyers have, we shouldn't be surprised. But this is a record early autumn auction market, Michael. Record in terms of listings and in terms of the number of sales that are being conducted is just significantly higher than we've ever seen before. And when we look back over the year, we can see that the Sydney market tracking still a little bit higher than a year ago. Melbourne a little bit lower than a year ago, despite that record listings. Brisbane a little higher, Adelaide similar to a year ago, and Canberra just showing some early signs of a revival.
Well, interestingly, at the end of last year, there were the property pessimists who came out and said more properties are coming on the market, more listings. That just means the property market's going to stall or go backwards. Really hasn't happened at all in 2024, has it, Andrew?
No, Michael, and should we be surprised that the pessimists are wrong again?
Some of those property bears seem to have hopped back into their caves to hibernate. We'll be back again next week to have a talk. The Reserve Bank interest rate decision will have come by then, and we can talk a bit about what goes on in the thinking of the Reserve Bank. It's not as simple as just one factor, is it?
No, it's not, Michael, and it helps to understand the future direction, particularly of interest rates, when we do analyse the factors as an aggregate group, as a whole, not just one factor at a time. And we'll look at that next week. And we'll also have some other interesting data. We'll have the latest labour market data, and we'll also have the latest migration data.
Migration data will be interesting, and I bet you will cause some controversy. Let's have a chat then. Thank you, Andrew.
Well, we'll see. Thanks, Michael.